Very interesting times that we're looking at right now. 147 to the euro is what the dollar is right now. And of course, we are seeing a little bit of risk aversion coming to the fore. Many say it's just about repatriation of money and really just some of those investors locking in the profits that we've been seeing in emerging markets.
I think that what we've seen in the last couple of weeks is actually a reasonable amount of bad news, in the sense that growth in Japan has not been nearly as strong as we thought, and there's also the downgrades for Greece, Spain, etc. So some risk aversion coming in, and risk aversion at this stage still actually strengthening the dollar, interestingly enough. The dollar going down on optimism and up on risk aversion, interestingly.
Exactly. I mean, you mentioned Japan's growth, third quarter coming in at 0.3% from an initial number of 1.2%. Do you think this is sparking worries about a double dip recovery?
I think it's not so much the double dip recovery as the fact that the recovery we're in is not nearly as strong as people thought. So there's that part which says the recovery is not as strong. The second part is that there are still a reasonable amount of financial worries around. So it's the debt that's being made by some of the countries that are over indebted that's coming home. But the other thing is there are also still some of the excesses of the bubble era, if you like, that is coming to the fore, as in Dubai.
Well, looking at the debt concerns that have emerged in Dubai, of course, in a lot of European countries, just looking at the European scenario that's playing out right now, do you think that investors are going to turn relatively pessimistic about the euro, given that we have seen a lot of debt fears emerging from these countries?
I think there is an element of that, because one of the things that investors have been buying in the European area is the debt of these countries that are issuing huge amount of debt. And what the rating agencies are now saying is the outlook for these countries in terms of fixing their fiscal issues are not that good, and Greece is one and Britain is another one.
Of course, but of course we know that these countries have had relatively high debt to GDP ratios. We've also known that the current account deficits have also been relatively high. The question is, has all this been priced in?
Not really. What's happening now is that the prospect that these countries are going to run huge government deficits for a very long time, and that they have these, all of them are in the situation where they're going to have to pay large pensions over the next 10 to 20 years. So on top of those pensions in the future, they now have to borrow a lot in the present, so their fiscal situation actually quite dire.
Do you think that this is going to be the theme for 2010, all of these debt concerns emerging from these countries? And do you think that it's going to create a lot of uncertainty regarding equities?
I think that the main theme that we're going to see in 2010 is, when do we actually start withdrawing some of the stimulus? That's actually going to be the main concern, I would think. And the secondary concern is going to be, for how long can we actually keep these huge government deficits going? Because as long as it was seen as a once-off emergency measure, that was reasonably, markets were reasonably comfortable with it. But as soon as you get a really strong upswing and you still have these big deficits, then interest rates will start to rise on the back of that, and you're actually going to see some problems emerging.
Well, just this morning we saw the Bank of Korea keeping rates unchanged at 2%, but then also citing fears about inflation as well. So obviously there's going to be quite a big balancing act between growth prospects and, of course, inflation.
Indeed, some places are already raising rates, like Australia. Some are giving a shot across the bows, like Korea. But Bernanke coming out saying, we're going to be very stimulatory for a long time yet.
And also saying that the US economy faces formidable headwinds. I mean, that also caused quite a lot of jitters, wouldn't you say?
On the one hand, it causes jitters. On the other hand, it says we're going to have the stimulus from the Fed for a long time. And that is really what has been driving markets up, is the huge amount of liquidity being created by the Fed. And there's really no prospect that that's going to end soon.
Also, just looking at the likes of the interest rates in the US, we know very close to zero, about 0.25%. On one hand, one would say, even if they do hike interest rates to, say, 1%, still very low interest rates. And if we do keep interest rates so low, in other words, at 0% or 0.25%, doesn't that head us into another bubble? Because
the bubble that people are talking about are actually, no, there are two bubbles that people are talking about. The one is in government bonds for the US, saying there's this huge amount of debt being created, but we're actually seeing very low rates on that debt. So if interest rates rise, you can see a major reversal. The other is in non-dollar assets. So anything that has been non-dollar has been performing tremendously well over the last year. So people have been borrowing in dollars, buying these non-dollar assets, and at some point when interest rates start to rise, that has to reverse as well.
In other words, emerging markets.
emerging markets to a very large extent, but to some extent also the euro, to some extent also commodities.
Wikus, what would you be doing with your portfolio right now? Is it time to rebalance?
I think rebalancing on a regular basis is actually a really good idea, but looking forward to 2010, you have to say that it's likely that markets are actually going to be very strong because we're going to see profit coming back and we're not going to see interest rates rise. So the two strong forces of the stock market, both pointing in the same direction, don't be out of the market.
There's basically two camps out there. You know, the ones that we're seeing invest in the likes of defensive stocks, you know, British American Tobacco, SAB, you know, the food retailers. On the other end, the braver people saying resources, that's the way to go. Of course, commodity prices are set to go even higher.
I think there's actually still quite a lot of value in the financials. I think that's one place where there's quite a lot of value. The other place, I think South African commodity stocks are actually not a bad bet in the sense that strong economic recovery will push commodity prices up, and we actually need to see the rand come back at some stage a little bit.
When do you expect that to happen, Wikus?
Towards the end of next year only.